Imagine waking up on the first of every month and seeing money deposited into your account. You didn't work for it. You didn't hustle for it. You literally made money while you were sleeping. Now, most people think this is some fantasy reserved for the ultra wealthy or people who got lucky with crypto. But here's the thing. There's a legitimate, proven strategy that regular people have been using for decades to generate monthly income from the stock market, and it's called dividend investing. And if you're someone who's tired of living paycheck to paycheck, or you're looking for a way to build wealth without constantly trading stocks or stressing over Bitcoin prices, this video is going to change the way you think about money. My name is Guy, and I spend way too much time thinking about how regular people can actually build wealth in a system that feels rigged against them. If you're someone who's been told to just save money and hope for the best, or you've been burned by get-rich-quick schemes and you're looking for something that actually works, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Today, we're breaking down dividend investing from the ground up. I'm going to show you exactly what it is, how it works, the math behind it, the psychology that makes it so powerful, and most importantly, how you can start building passive income, even if you're starting with just $100. And look, I know the stock market can feel intimidating. I get it. But by the end of this video, you're going to understand this better than 90% of people who are already investing. Let's go. Section 1. What dividend investing actually is. All right, so first things first, what is a dividend? A dividend is simply a portion of a company's profits that gets paid out to shareholders. Think of it like this. If you own a piece of a company and that company makes money, they can choose to give you a cut of those profits on a regular basis. That's a dividend. Now, here's what most people don't realize. Not every company pays dividends. In fact, a lot of the big, sexy tech stocks that everyone talks about, companies like Tesla or Amazon, they don't pay dividends at all. Why? Because they're reinvesting all their profits back into growing the business. But there's another category of companies, mature, stable, profitable companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. These companies have been around forever. They're not growing at 50% a year anymore. They're steady. And because they're steady, they reward their shareholders by paying out dividends, usually every 3 months. Here's a real example. Let's say you buy 100 shares of Coca-Cola at $60 a share. That's a $6,000 investment. Coca-Cola pays a dividend of about $1.84 per share annually. So if you own 100 shares, you're getting $184 a year in dividends, paid out in 4 quarterly payments of $46 each. You didn't have to do anything. You just owned the stock, and every quarter, money showed up in your account. Now, $184 might not sound life-changing, but this is where it gets really interesting. Because if you reinvest those dividends to buy more shares, and those shares pay more dividends, and you reinvest those, you start to create a snowball effect. Over time, this compounds into serious wealth. Section 2, the math that will blow your mind. Let me show you the math, because this is where people's minds start to explode. Let's say you invest $10,000 into a dividend stock that yields 4% annually. That's $400 in dividends in year 1. Not bad, but not crazy either, right? But here's the thing. If you reinvest that $400 back into the stock, now you have $10,400 invested. The next year, your 4% dividend is calculated on $10,400, not $10,000. So you get $416 in dividends in year 2. You keep doing this year after year and over 30 years, assuming the stock price stays flat, which by the way, it probably won't, your $10,000 investment grows to over $32,000 just from reinvesting dividends. But wait, it gets better. Most dividend-paying companies also increase their dividends over time. Coca-Cola, for example, has increased its dividend for 62 consecutive years. So not only are you getting dividends on more shares, you're getting bigger dividends per share. When you factor in dividend growth, that same $10,000 investment with just a 5% annual dividend increase can grow to over $50,000 in 30 years. And that's not even counting the stock price going up, which it likely will. This is the power of compounding. Einstein allegedly called it the 8th wonder of the world. And here's what most people don't realize. You don't need to be rich to take advantage of this. You just need to start early and stay consistent. Section 3. The psychology behind why this works. Now, let's talk about the psychology, because this is actually more important than the math. Here's the thing. Most people fail at investing not because they don't understand the strategy, but because they can't control their emotions. They buy high when everyone's excited, and they panic sell when the market crashes. They chase the hot stock tip from their cousin, and they lose money. Dividend investing solves this problem in a beautiful way. How? Because it gives you regular, tangible rewards. Look, human beings are wired for instant gratification. We want to see results now. That's why saving for retirement feels so abstract and boring. You're putting money away for some version of yourself 30 years from now, and your brain just doesn't connect with that. But with dividend investing, every quarter you get paid. You see money hit your account. It's real, it's tangible. And that feedback loop keeps you engaged and motivated to keep investing. There's another psychological benefit. When the market crashes, and it will crash, dividend investors actually get excited. Why? Because when stock prices drop, dividend yields go up. If a stock is paying $2 a year in dividends and the price drops from $50 to $40, your yield just jumped from 4% to 5%. So instead of panicking, you're buying more shares at a discount and locking in higher yields. This mindset shift is everything. It turns market volatility from a source of anxiety into an opportunity. Now, you might be thinking, okay, Guy, this sounds great, but how do I actually start? What stocks do I buy? How much money do I need? Let's get into it. Section 4, how to actually start dividend investing. All right, here's your step-by-step game plan. Step 1, open a brokerage account. You need somewhere to buy stocks. I recommend using a platform like Fidelity, Charles Schwab, or Vanguard. These are legit, established brokers with zero commission trading. You can open an account in like 10 minutes from your phone. Step 2, decide how much you can invest. Here's the truth. You don't need thousands of dollars to start. You can literally start with $100. Some brokers even let you buy fractional shares, meaning you can own a piece of a stock even if the full share costs $200. The key is consistency. If you can invest $100 a month, do that. If you can do $500, even better. The amount doesn't matter as much as the habit. Step 3, choose your dividend stocks or ETFs. Now, this is where people get overwhelmed. There are thousands of stocks out there. How do you know which ones to pick? Here's my advice. If you're a beginner, start with dividend ETFs. An ETF is like a basket of stocks. Instead of buying one company, you're buying a little piece of 50 or 100 companies all at once. This gives you instant diversification and reduces your risk. Some of the best dividend ETFs for beginners include Vanguard Dividend Appreciation ETF, ticker VIG. This fund focuses on companies with a history of increasing their dividends every year. These are solid, reliable businesses. The yield is around 2%, which is modest, but the dividend growth is strong. Schwab US Dividend Equity ETF, ticker SCHD. This is one of my personal favorites. It focuses on high quality, high yield dividend stocks. The yield is around 3.5%, and it has a great track record. SPDR S&P Dividend ETF, ticker SDY. This fund invests in companies that have increased dividends for at least 20 consecutive years. These are the dividend aristocrats. The yield is around 2.5%. If you want to go the individual stock route, look for companies with a long history of paying and increasing dividends. Some examples. Johnson & Johnson, ticker JNJ, healthcare giant, 60 plus years of dividend increases. Yield around 3%. Procter & Gamble, ticker PG, consumer goods, think Tide, Pampers, Gillette, 67 years of dividend increases, yield around 2.5%. Realty Income, ticker O. This is a real estate investment trust, or REIT. They actually pay dividends monthly, not quarterly. Yield around 5%. The key is to focus on quality. You want companies with strong balance sheets, consistent earnings, and a track record of paying dividends through recessions. Step 4. Set up automatic dividend reinvestment. Most brokers have something called a DRIP, which stands for Dividend Reinvestment Plan. This automatically takes your dividends and uses them to buy more shares. You set it up once, and then it runs on autopilot. This is how you supercharge the compounding effect. Step 5. Be patient and stay consistent. This is not a get-rich-quick scheme. Dividend investing is a long game. You're building wealth slowly, steadily, and reliably. You're not going to double your money in 6 months, but over 10, 20, 30 years, this strategy will absolutely change your financial life. Section 5. The risks you need to know about. Now look, I'd be doing you a disservice if I didn't talk about the risks, because they're real. Risk number 1. Dividend cuts. Companies can reduce or eliminate their dividends at any time. This usually happens during recessions or if the company runs into financial trouble. In 2020, during the pandemic, dozens of companies slashed their dividends. It happens. How do you protect yourself? Diversification. Don't put all your money into 1 or 2 stocks. Spread it across multiple companies or use an ETF. Risk number 2, interest rate sensitivity. When interest rates go up, dividend stocks often go down. Why? Because bonds start looking more attractive. If you can get 5% from a safe government bond, why take the risk of owning a stock that yields 3%? This doesn't mean dividend investing is bad. It just means you need to be aware of the interest rate environment and adjust your expectations. Risk number 3, the high yield trap. If you see a stock with a 10% or 12% dividend yield, your first instinct might be to buy it. But here's the thing, a super high yield is often a red flag. It usually means the stock price has crashed and investors are worried the company might cut its dividend. Don't chase yield. Focus on quality and sustainability. Section 6, the bigger picture. Here's what I want you to understand. Dividend investing is not just about the money. It's about building a mindset. When you start investing in dividend stocks, you're training yourself to think like an owner, not a consumer. You're not buying lottery tickets. You're buying pieces of real businesses that generate real cash flow. And over time, those cash flows start to replace your paycheck. Imagine getting to a point where your dividends cover your rent or your car payment or your groceries. That's financial freedom. And here's the best part. This strategy is available to anyone. You don't need to be an expert. You don't need to day trade. You don't need to time the market. You just need to be patient, consistent, and disciplined. The people who build wealth through dividend investing aren't the smartest people in the room. They're just the most patient. So here's your action plan. 1, open a brokerage account this week. Not next month, this week. 2, start with an amount you're comfortable with, even if it's just $50 or $100. 3, buy a dividend ETF like SCHD or VIG. Keep it simple. 4, set up automatic dividend reinvestment. 5, commit to adding money every single month. Even if it's small, consistency beats everything. Look, I'm not going to sit here and promise you're going to be a millionaire in 5 years. But I will promise you this. If you follow this strategy, if you stay consistent, if you give it time, you will build wealth. You will create passive income. And you will set yourself up for a financial future that most people only dream about. So go do it. Stop waiting, stop overthinking, start investing. If this video helped you, smash that like button, subscribe to the channel, and drop a comment below telling me what dividend stock or ETF you're going to start with. I read every single comment and I want to hear from you. Thanks for watching. I'll see you in the next one.